Today I'm going to be talking about a company called GameStop. Now, what's interesting about this stock is that it was trading around $2 a share around March 2020, but as of now I think it's above $200. Now, did something remarkable happen with this company, incredible earnings, or is it doing something revolutionary? No, not really. This is a company that sells basically things for video games. They can sell consoles, they can sell video games. I think they used to even rent them out, and a lot of hedge funds have been shorting this stock actually, and a lot of hedge funds actually have to reveal what they're doing. There's some kind of mandatory disclosure forms. So if they're shorting this company, they have to disclose it. And these people on this internet site called Reddit, there's a forum called Wall Street Bets, and basically these are the most aggressive, really innovative people. Most of them are probably rather young and aggressive and very focused on trying to take out the biggest hedge funds in the world, because these hedge funds, their weakness is they had to disclose exactly what they're doing, and that's going to be to their detriment, because these people who realize that they're heavily short on this company called GameStop, well, these Wall Street Bets people, they decided to buy a ton of the stock and make a massive move upward. I mean, every day it's going up like 80 or 100%, and even on the after hours it's going up through to like a rocket. It even got Elon Musk to tweet about it recently. Now, what is this actually? What are the lessons that we should learn from GameStop? Well, for one thing, there is no such thing as an efficient price for a stock. This proves that stocks are worth what people are willing to pay for it at that point in time. I mean, this stock was going for $2 a share or something like that, or maybe $3 a share in March of last year. And what changed? Well, nothing. Just the fact that people understood that there's a weakness inherent in the short position, and so people could take advantage of that. And people certainly are taking full advantage of this, as they should. Now, the other thing about this is that this shows you the dangers of being a large dinosaur like a hedge fund, where you have to reveal exactly what you are doing, because there are vultures out there who will definitely take advantage of the fact that you have to disclose what you're doing, but then people can take the opposite side of that position in order to harm you. And some hedge funds have actually had to get bailouts, not from federal government, but from other hedge funds, I guess, that were not as exposed. And the truth is that this shows you that their anti-fragile strategy of shorting a company is through puts, not through a naked short. Because when you short a stock, eventually you have to buy it to cover it back. Now, you hope to do it from a lower position. You hope that the stock actually goes down, you buy it back, and you make a profit. Well, but if the stock goes up, you have unlimited potential for losses. And since these are massive hedge funds, some of them have to buy a massive amount of stock back at a very inflated price. I mean, this stock is not worth what it is at the moment. That doesn't matter. The truth is, it doesn't matter, because we don't really know how high the stock will end up going. Because it doesn't. You can argue with the market and say, well, it's not worth 200 a share. It's probably worth more like 10 or 11. Well, who cares what it's really worth? The market says at the moment it's worth 200 a share, and people have to live with it like it is. The other thing that this does is this is proving that the academic theory of efficient market, it just doesn't exist in reality. This academic theory, if you go to college and major in economics, the professors will tell you that stock prices reflect the efficient view of all of the available information that exists out there and all of the disclosed things that are sent to the SEC, and that's what impacts the market. That's what causes the price to be what it is. But the truth is that people who actually invest in the market, they realize that that's actually not the case. The price of a stock reflects whatever people say it is at that moment in time, and it can actually be completely irrational. There's no requirement that the market has to be rational or has to be the proper price or has to be the price that professors think that it is. The price can reflect the sentiment of people on a random internet site called Reddit in the Wall Street Bets forum. So that shows you that it's actually not the case. The efficient market is not a correct theory. The other thing is you have to always be aware of these black swan events. There will be events like this that we cannot predict. I mean, in the beginning of the year, we would never have said, oh, GameStop, that's going to be the top stock of the year. You can never predict stuff like that. Now, if you're betting against a company like GameStop, you have to really think this through a little bit more and realize that, yes, something like this can indeed happen, and it will happen. It's really only a matter of time before something dramatic like this happens. Too many people think, oh, well, the odds don't favor it, so it's not going to happen. Well, that's not correct. This can and does happen. And it also shows that just because something makes sense, like the theory, oh, all the retail stocks are going to die out, and why would GameStop do well for selling video games? Well, you could buy it on Amazon. And everybody's moving towards towards other sites where you can buy games like Steam and things like that. But the truth is, those narratives don't matter. If for the moment people say they believe in GameStop, if they believe in GameStop and they want to actually buy it, that's what's going to happen. It doesn't really matter if it makes sense or not. And too many people want to argue with the market instead of just accepting the market as it actually exists. That's a huge problem. And so you have a situation right now where people who are probably around 18 or 20 years old, they are fighting against the largest hedge funds in the world, and they're winning. And if you want to know why that is, it shows you that too many of these hedge funds are built on academic theories like the efficient market theory, or they think that they have taken a risk assessment based upon statistics. But this is one of those black swan events. I don't think that they are properly capable of really understanding what kind of situation they are in whatsoever. I think that they are completely clueless on this. And I think people on the internet kind of really love this because this is an ultimate David versus Goliath. I think people love the fact that it's the largest hedge funds in the world and they're losing to a bunch of dorks on an internet forum. I mean, that's the ultimate story. I mean, it's the kind of story that everybody wishes would happen. And I think that shows you also that Wall Street, these people are not smarter than the average person out there. They can lose way more than average person just because they have more money. They're not any smarter than the average person. I would say that it seems like these Wall Street Bets people on the Reddit forum, I think that in many ways they're smarter than the Wall Street folks. And I think a lot of people are cheering them on too. Anyway, I do look forward to hearing what you have to say about this incredible rise in GameStop. I have not bought it, and thankfully have not shorted it either. But I do look forward to hearing your views in the comments below. What do you think of this exciting development? And what do you think is the next thing that's going to have a massive rise up like GameStop? Because it's pretty exciting. Anyway, see you in the next video. Bye-bye. Be sure to like the video and subscribe. I'm waiting for that.